Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's episode is sponsored by Building Insurance and Risk. When you invest in real estate, work with the experts at Building Insurance and Risk. There you will receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Jacob Vanderslice. Jacob is a principal at Van West Partners, a Denver-based real estate investment firm focusing on acquisition and management of self-storage centers and other opportunistic real estate throughout the United States. Van West has established a track record with over $195 million in real estate assets. And in just a minute, we're going to speak with Jacob about self-storage, investing in self-storage during an economy of change. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple of things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Jacob Vanderslice. Welcome to CRE PN Radio.
Good morning, Darren. Thanks for having us on.
Well, I'm excited to speak with you today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, I'm a principal at Van West Partners. We're a private equity shop based out of Denver. I've been investing in real estate full-time since about 2006. We started off in the residential space. We did a lot of single-family residential buy, fix, and sell deals over the years, well over 1,000. We got into the commercial real estate space in 13 and 14, doing adaptive reuse retail projects around Denver. And then we got into self-storage in 2015, and we started off with a few ground-up development projects locally and then kind of kept it going. So we got into the asset class because we liked its historic downside protection, scalable, durable, repeatable income streams. And we didn't really get into storage thinking we were going to become a primary self-storage operator as a primary line of business. We just kind of did a deal or two and kept going. And that's evolved into being our main line of business. We still own and operate some of our retail projects around town and a bunch of single family rentals. But I'd say 95% of our bandwidth is self-storage.
Got it. You mentioned partners. How many partners do you have at Van West?
So I've got three partners. One of them is Aaron Westfall. We go back to junior high together. We've been partners in really everything we've done since 2009. Wade Buxton, he joined us as a partner in 2014. And our most recent partner is John Sutterth. He joined us as a partner in October of last year, and he came from another self-storage investment company, and he's an expert in ground-up development. So John is leading our development initiative.
Yeah, so everybody has kind of an area of expertise then, is that?
Yeah, we're a relatively small shop. We kind of wear certain hats, but there's of course a lot of overlap too.
Got it. So you mentioned your kind of evolution, starting with the single family. It sounds like you guys are pretty involved in the flips, 1,000 flips. That's not you tried and it didn't work. Was that more a matter of just the timing? Was that, it sounded like you started kind of post crash, if I got my notes right there.
It worked for a long time, and we kept the business going with our other lines of business really until about probably 2 years ago. And the reason my partners say we shut it down, I say we paused it indefinitely because I sure enjoy the single family business. But the reason we shut it down was couple issues. One, deal flow is challenging. If you're sourcing deals today in the single family space, in a lot of spaces, you're probably doing a lot of marketing, direct to seller marketing. And those fixed costs can become pretty high when you're not doing a lot of volume in a really tight market. The other reason we pivoted is mainly we kind of looked ourselves in the mirror and decided that we want to get away from transactional income streams. We want to get away from buying, making better, and selling over and over again, and start buying, making better, and building an asset base with recurring revenue streams and recurring cash flow. And we thought storage was a great vehicle for that. And a lot of guys have done that in single family residential. We did that to a small degree with our rental portfolio. But we just wanted to get away from being traders to building a larger asset base for the long haul. And we thought storage was a good vehicle for that. So that's some of the reasons for the pivot.
No, I love it. The kind of get rich slow kind of a thing is acquire it and let the rents grow up and the tenants pay down the mortgage and I mean I love the cash flow of real estate and how it keeps growing with inflation and that's awesome.
Yeah. I think the definition of wealth is it's not net worth. I think it's passive recurring revenue streams.
Yeah. No, I vacillate because sometimes I get caught up in the net worth side of the equation, and then you have something like what's going on right now where everything may be revalued, and that may not be what you thought it was.
Yeah, if your net worth is not paying you on a monthly or quarterly basis, you got to reevaluate that. I mean, let's say I deed you a $10 million mansion, free and clear, right?
Right.
Well, you got to pay the property taxes, you got to pay the landscaping and all the utility bills. And the only way for you to monetize that $10 million asset is to either put debt on it and have a mortgage payment or sell it. It doesn't produce any income. So we like assets that produce income.
Yeah. Amen to that. So you mentioned your strategy. It sounded like you started off doing some ground up. Is that your current strategy, or are you guys also acquiring existing facilities?
Yeah, so we do both. We recently launched our third self-storage fund, and Fund 3 is focusing on buying undermanaged existing facilities and adding value with occupancy and revenue growth and capital improvements on the front end. Our development line of business for right now, we're doing our development deals in single asset syndications. And briefly, for those of us listening who may not be clear on the difference, a fund is typically a collection of assets that you invest in, and you're participating in the economics of the entire fund's asset base. So if the fund has a deal that's underperforming for whatever reason, that deal is hopefully balanced out by the other 10 deals that are on forecast or ahead of forecast. And a syndication is typically just a single asset. So you form an LLC, you buy a deal, you go out and execute. But if that deal doesn't go well, there's no other sources of revenue to kind of shore up the deal's income statement. So the reason we're doing our development projects and single asset syndications is really primarily because ground up development is too different of a risk profile. I know we'll touch on risk later, but it's too different of a risk profile than buying existing facilities. You're taking entitlement risk, hard cost risk. Even if you buy a facility that's empty, you're eliminating the construction risk because you have a building on the site. You still have lease up risk and revenue forecasting risk. But the profile is different on a development project, and that's why we're doing them outside of Fund 3 for now.
Yeah, no, I love the explanation and pretty clear as to the whys there. That's great. As far as your portfolio right now, before we started recording, you mentioned you guys are Denver based. Are your properties primarily in the Denver area, or whereabouts are you guys located?
They're actually not. Unfortunately, we love our backyard. I'm a Colorado native, but finding arbitrage here is difficult, just given how inflated the environment's become. We have not done much in Denver, with the exception of we bought a value add acquisition on December 31st in a town called Loveland, kind of between Denver and Fort Collins. And then we bought a development acquisition in Longmont, which is south of Loveland, kind of between Denver and Loveland. Bought that about 2 weeks ago. So until recently, we haven't really done much in Denver, other than a few deals here and there for some number of years. So most of our portfolio is concentrated in the Midwest and Southeast and Southwest. So we have deals in Wisconsin, Illinois, Michigan, Ohio, North Carolina, Tennessee, Georgia, Florida, Arizona, soon to be Oklahoma. So those are some of the states we covered.
Yeah, and these are all self-storage?
All self-storage, yeah. And these kind of secondary and tertiary markets have been attractive, especially lately, because we found they have a good blend of current yield with capital appreciation. If you're buying storage deals in primary markets like Seattle or LA, for example, cap rates are excessively compressed and values are very high. So your yields from a current cash flow perspective are pretty light. The total returns of the deal might still be fairly attractive, but that dividend yield along the way is much lower than it would be, say, in Pensacola, Florida, or Charlotte, North Carolina.
Yeah, no, that's kind of more of a transactional kind of a approach, I think. At least unless you're coming all with cash, like some big REIT or something like that, or at least that's kind of what I have come to understand about that. So in these secondary and tertiary markets that you're, or not second, secondary and tertiary markets that you're investing in, what's the criteria that you look for in a market?
Well, I guess we'll start specifically with self-storage. So the first thing we look at are supply ratios. So how much supply is in the submarket? Self-storage is very sensitive to supply, and it kind of depends on the market. So some markets can have fairly high amounts of supply, but the facilities are full because the rates are fairly low. And the reason they're full is because more consumers can afford to store at 90-cent rates than they can at $2.50 rates, right? So we look at supply ratios first, and then we also analyze objectively and subjectively to a degree the risk of the introduction of new supply in the foreseeable future. So are there building permits being pulled nearby? Has someone gone into a pre-flight concept review with the city to see if they can build storage? That's one of the bigger risks in our industry, again, is the unforecasted introduction of new supply. So those are really some self-storage specific things we look at. And beyond that, we're looking for deals that are well located in markets with a story for population growth, good demographics. We look for housing density. We stay away from deals in overly rural locations just because there's not the consumer base out there to store than there might be in a more dense location. So to a degree, I'd say we're fairly geographically agnostic. If there's a deal in a new market that makes sense, we'll probably go there as long as we believe we can get scale in that market. There aren't really markets that we're saying no to, but there's certainly markets we're not targeting, like the Northeast, for example. We're not looking too carefully up there for a number of reasons. California is tough to get stuff done. So we generally like the higher growth opportunity markets where we can buy at a discount but still get a good return on a current basis and good story for appreciation too.
You mentioned tough to get it done. I'm kind of curious, self-storage by itself as opposed to like a multifamily, something more housing related. Is there a lot of resistance, or is it more of just each jurisdiction has their own little persnickety way of doing things?
Yeah, I mean, it certainly varies from city to city, but generally there's a lot more resistance from a zoning code and entitlement perspective to self-storage than there used to be. Cities don't love it for whatever reason. It's got lower sales tax revenue. It's not a use they generally want to see. They want to see a grocer come in, or they want to see big box retail come in with high sales tax revenues. So one of the reasons we're developing now is we have never seen the barriers to entry for development higher than they are now. And there's really two reasons for that. One is what I just mentioned. It's really tough to get projects entitled. It takes sometimes a year to get your building permit, depending on the market you're building in. And secondly, which is kind of obvious given the environment that we're in, hard costs have gone up substantially, of course, compared to where they were a couple of years ago. So rents, thankfully, have gone up incrementally more than hard costs have. So it makes sense to take higher cost basis because rents are up and they're probably going to be up for a while. So that's one of the reasons, or two of the reasons I should say, why we like developing right now, generally just because once that project's completed, it's going to be really tough for a competitor to replicate it anytime in the foreseeable future.
Yeah, that makes complete sense if you have a lock on keeping the competition out. You mentioned kind of the rates, I think you said somewhere around 90 cents versus like 250. Um, is there is that rate, is it fairly steady across the territories you're in, or does it vary dramatically based on uh, the particular MSA or area that you're investing in?
Yeah, it certainly varies dramatically from MSA to MSA, but within that sub market, there are certainly variances. I wouldn't call them dramatic though. For example, if you have a new building that's climate controlled, a 10 by 10 is going to get a higher rate than a 30-year-old building that's single story drive up non-climate controlled down the street. So there's some variances on the revenues as it relates to the location and the building quality and whether it's climate controlled or not. But they're not massive, but they move the needle a lot. I mean, if you're modeling out a storage acquisition, plus or minus 10 cents per square foot per month, amortized across hundreds of units, can really move the needle from a return perspective, both up and down.
Yeah, no, I can imagine. With the different projects that you're doing, or I would assume anything new you're doing, more of a climate control. Is that typically the case, or?
Yeah, our value add acquisitions we're doing are a mix of climate control and non-climate control. Some are multi-story, some are single story. But our development projects are by and large multi-story climate control, with the exception of one deal we've got that we closed on about 2 weeks ago in Longmont. That deal is going to be single story climate controlled units and non-climate controlled units, kind of a mix. And we configure the buildings based on the sub-market demand. Some sub-markets that are a little more suburban, they don't want to ride elevators up to store their stuff because they have plenty of options to not do that. Think about if you're storing, do you want to show up to your unit in your truck right there and open the door and unload? Or do you want to put your stuff on a cart, push it through a doorway, wait for an elevator, ride the elevator, push it down the hallway, and kind of rinse and repeat? So we're only doing the multi-story locations in sub-markets that support that building type. Yeah.
Got it. And as far as uh, or I guess you've kind of alluded to and suggested most of what you're doing now is new development as opposed to buying existing, or?
Well, Fund Three is buying existing. So
Okay.
we bought about 2 deals so far this year, totaling about 23 million in total cost. It's been a slow start to acquisitions given the environment. We've got quite a few deals though in the pipeline we're excited about. We have 4 properties in Oklahoma. We have another deal in Michigan. We've got some stuff in Florida that's pending, South Carolina. So yeah, Fund Three is only buying existing facilities, but our single asset syndications are doing raw land ground up development. So we're doing both. Yep.
Got it. That's right. You mentioned that. So with the acquisition of the existing, are you finding that are they kind of just an older owner that's kind of tired, or is it like another investment firm that's looking to get out, or what's the?
Yeah, it varies. I would say the bigger owners that we buy from are kind of smaller regional operators who might have constructed a portfolio over many years and they're finally monetizing it. Other owners are just kind of folks that fell into the business. They've owned it for 20 years. And the reason we can find arbitrage on deals like that might be 95% occupied is because their rates are too low and they lack the capital to do the necessary repairs, to kind of upgrade the building. Sometimes they don't have very sophisticated revenue management in place. Self-storage revenue streams are very dynamic. They vary by the season, by the unit type. And in some cases, they don't have a website, which is amazing. But a lot of these operators don't have websites. They have a landline. You call them up, you lease your unit. And obviously customers don't like that these days. So we upgrade the facilities. We add value with rebranding improvements and mainly from our operational platform.
Got it. And as far as the territory that you guys are invested in, how do you go about managing? Do you have employees, or do you sub that out, or what's the management?
Yeah, we used to outsource our property management to the national REITs when we first got in the business. And we were initially dazzled by their revenue management algorithms, their branding, their marketing platform. And after the honeymoon was over, we realized that they just don't care about your deal as much as you do. They're a third party. There's a lot of revenue streams, ancillary revenue streams in the business that they would keep and not share with the ownership group. So we formed our own management platform about 4.5 years ago called Clear Home Self Storage. And we started taking our deals back from the REITs, and everything we've bought since we self-manage. Property management is painful. It's not very profitable, but growing revenue and growing NOI are the keys to delivering value to your investors and to the asset base. So that's why we self-manage. As far as our staffing goes, we've got about 75 employees. 15 of those are here in our Denver office, and the balance are scattered around the country, on-site managers, regional managers in our various self-storage facilities.
Got it. And I think, what I always find interesting is how a lot of times they think of investing as like just putting money in and getting money out, as opposed to actually the human capital of managing, an asset, especially when you're not, using a third party manager kind of thing. It's an actual a business as opposed to just an investment where you place capital and you get a return kind of thing. Any challenges that you recognize that you've run into with more the human capital management?
Oh, absolutely. Staffing is a major challenge, and it varies from market to market. One specific market, for whatever reason, we have a really tough time finding and retaining talent is Columbus, Ohio. I don't know what it is with that area, but we've gone through a number of employees on one of our sites out there. Versus the Florida Panhandle, we've got amazing employees there who have stayed with us for a long time. But staffing is generally a big challenge. We've had people, had a great interview. They're scheduled to start Monday. They don't even show up. They never call us back again. That's happened numerous times. But we're also, we're talking about employees that are making, high teens, $20 an hour hourly wages. So they tend to be a little bit more transitory sometimes, but when we find someone good, we treat them right. We do everything we can to retain them.
Yeah, no, I'll bet, because I just know that the turnover thing is just like, it's just a buzzkill from a standpoint of like everything's up and running. Now you got to teach somebody new or find somebody new. So
yep.
I get it.
Thankfully, self-storage, it's a very operationally intensive business. Believe it or not, it's not. People think, oh, no tenants, no toilets, no problems. That could not be further from the truth. I mean, we have problems every day. We have people sleeping in units. We have theft issues when we have thousands of units around the country. Given that scale, bad stuff's going to happen every day. But thankfully, overall, the industry is not as reliant on a person being there all the time as other industries might be, because our customers can lease units online, get their gate code online. If they choose to, they don't have to talk to a person throughout their entire leasing experience with us. So the people component's very important, but it doesn't put our lights out if we have a staffing issue on a given deal.
Yeah, no, that is key. I love that fact that you've got it all online where somebody can do it. And more, I think people are just they get frustrated if it's not an option.
Myself included. I mean, every morning on the way to the office, I do a Starbucks mobile order. The baristas are great people and they're nice to talk to, but if I can just blast in there and pick up my coffee off the counter and leave, that's what I prefer. So
yeah,
people are the same way.
Yeah, no, I think there's certain applications where it makes complete sense to have little or no contact, where there's other things where there's an expertise that's required that's not clear on the website that
Yep.
caused me some frustration. But
Yep.
But is there a minimum number of units you guys look for when you're buying a new property?
It's not so much a unit count. It's really two things. It's net rentable square footage and total dollars. You'll probably agree with this, but it takes about as much time, if not more, to do a small deal as it does a big deal. So we're not going to go. I mean, we'll look at stuff as small as maybe 25 or 30,000 square feet. But if it's a new deal in a new market, we're probably not going to do that just because it's relatively small. But if it's a deal in an existing submarket we're already in, we might look at that a little more carefully because we can buy that deal and have our fixed costs as far as staffing amortized across a larger number of units in the market versus just one deal. So yeah, generally it's 25 to 30,000 square feet minimum. If it's a new market, a new deal, it's got to be at least 50. And we really don't like to do anything under, $3 to $4 million. That's probably even on the lower end. One of the smaller deals we bought in the last couple of years was about 5 million. And those are big numbers to you and I, of course, as individuals, but for a sizable self-storage fund, it's just not a very efficient use of time and resources.
Yeah, I get it. No, and you're right. I mean, if you're putting in the effort and you're, running the deal, it's a whole lot more rewarding if you're able to get a larger deal and because you put the same amount of time
$1 million deal is still the same third-party reports, phase 1, phase 2, survey, property condition report. It's still loan docs with a banker. It's still tax returns. It's still K1s. So yeah, we like to deploy larger amounts of capital, just given the fact that there's fixed time and fixed costs in every deal.
I remember somebody said one time, less widgets, more digits. That was kind of
That's right. That's right. Yep.
But hey, let's talk a little bit about self-storage in the changing economy. Before we started recording, and anybody that's listening knows that the Fed has kind of got their pedal to the metal, trying to break inflation and increase interest rates and do anything possible to slow it down, which obviously is going to reset values and just the way people respond, kind of thing. And given that, I'm just kind of curious, what are you seeing? Do you have any kind of highlight list of things that you're seeing in just the change from a year ago to now?
Yeah, certainly. I mean, it's very dynamic, right? It's kind of changing by the month, if not the week. There has been so much new capital that wants to be in self-storage the last couple of years. That new capital and that large amount of capital that wants to be in the space is still there. And that capital is still buying assets. So that demand from investors is still keeping values up and cap rates compressed. I think that's, again, just a function of the demand that's out there. Eventually, though, in a rising rate environment, you cannot continue to sustain compressed cap rates, right? If your cost of capital on the debt side is going up, you can't finance at a 6% rate and buy a deal at a 4 cap, right? It just doesn't work. So eventually cap rates are going to have to go up and values will have to go down and kind of moderate. We're seeing some anecdotal evidence that cap rates are increasing a little bit, but it's so variable from market to market and deal to deal. You might say cap rates have gone up 25 basis points in general, something like that. So if a stabilized deal was trading in a 4 cap a year ago, it's probably trading at a 4.25 today. Competitive bidding situations, which there are still many of. In fact, most deals that hit the market have a lot of offers. We're generally seeing seller expectations for the most part still being met, but fewer buyers getting to that price point. And I'll talk out both sides of my mouth. At the same time, we're seeing some retrades here and there. So guys are going under contract on deals with a longer contract, maybe 4 months, and they get to the 3rd month in their DD and their underwritten interest rate was 4, and now it's 5.5 or 6. So they're going to sellers saying, dude, my numbers don't work anymore. I need X off the property or I'm going to have to walk. And some sellers are agreeing to those price reductions and others are not. But the bid ask is certainly widening. But by and large, most sellers are hitting their numbers, but we're seeing that shift, especially the last couple of months. As far as how we're positioning ourselves in an uncertain economic environment and likely either in a recession or entering one, we're not departing from our disciplined underwriting standards. We're being conservative. We're setting assumptions in our models that we believe are very reasonable and achievable. We're not going out and saying if everything goes perfectly, we're going to get a 16% IRR, right? But if it doesn't, we're going to get 4. We're going to lose money. And because of that, deal flow is challenging. We offer on a lot of deals every week, and we get a small percentage of those. And most of our deal flow has been off market, either completely off market, direct to seller, or with a broker relationship, or inefficiently marketed. Maybe someone has a cousin at Remax and they put their storage facility on the MLS and nobody sees it who's supposed to. But yeah, we're definitely watching things change very carefully. I would say the biggest change on the debt side from this time a year ago is not including interest rates. Obviously, they're up. But really 2 things. Term on the debt has changed. So we were getting 10-year fixed financing left and right last year. This time this year, last couple of months, we're doing some floating rate product, and we're also seeing on our term debt, we're getting either 5 or 7 years. We're not getting 10. We're also seeing proceeds go down a little bit. If we had go-to lenders that were at 65 or 70% of costs last year, now they're at 60 or 65. We're also, historically, it's been a lot easier on the debt side to do a massive deal than a relatively small deal. And right now, that's shifted kind of for the first time. We're leveraging our more regional lenders and our relationship lenders more so than we were, for example, our national massive lenders like last year. Those guys are still down the lend, and some of the bigger folks are really pulling back, or they're even paused until this whole thing kind of shakes out. We have a little more clarity. So the debt markets have definitely changed, but whether we're building a facility or we're buying an existing one, our target is always cash flow. Cash flow is what lets you survive in a downturn. Notwithstanding a debt maturity coming up pretty soon, even if your values go down, if you have good cash flow and good debt service coverage, you can survive. And we're not trying to just survive; we're trying to thrive, of course. But that recurring revenue and cash flow is what lets you get to the next cycle. So we're very focused on that.
Yeah, no, I think that makes a lot of sense. You mentioned, kind of the financing terrain and how it's changed, and you mentioned there's lots of capital looking to invest. Are you having any, or has your experience changed with raising capital? Are the conversations different today with potential investors than they were a year ago?
They absolutely are. Yeah, our capital raising has still been fairly robust. People are definitely pulling back. We're getting the equity we need to fund our deals, but I'm not sure. I mean, there's a couple of reasons that might be behind that. One is we launched a new fund. We're early on in Fund 3. Fund 2 was closing late last year, and we had so much equity coming in, we had to turn guys away because we didn't have the capacity for it. So when you're launching a new fund, there's not really a sense of urgency to a degree to get in now. A lot of guys say, give me a quarter or two, keep sending me your updates. Let's see how things go. Then I'll put some money in. But on the other side of it too, I think the drop in public equities has not helped. And the lacking confidence that's increasing by the week is obviously not helping either. But we really believe that self-storage is a defensible place to be during times of uncertainty, which is why we're all in on the strategy. It's performed historically well during downturns. It performed really well during the pandemic. So we think it's a good spot to be. There's, of course, risk in every investment, every real estate investment, but now is not the time to go out and stretch on a Class A office development, right? Right. Now it's time to buy tired storage facilities with very granular month-to-month leases that you can respond to real time based on supply and demand, and kind of circle the wagons. So that's why we like storage.
Got it. And as far as the your customers, the renters, the tenants that lease from you guys, do you expect in a market as interest rates change and kind of the uncertainty, is there the room for rent growth, or is that kind of is your forecast or your pro forma kind of look to kind of hold more as opposed to maybe a more aggressive rent growth strategy?
Yeah, we both our portfolio and the portfolio of many other operators have seen just record revenue growth and NOI growth, both from increased consumer demand and inflation in the last year. Our forecast, which is always wrong, of course, we think that customers are getting to kind of a breaking point on how high you can push rents. So we see a small reduction in asking rates, maybe starting in Q4 and going into 2023, because we just think customers are just hitting that kind of ceiling on what they can pay. They're seeing their gas prices go up, their rent's going up, everything in their life is increasing, including their storage rent, and you can only do so much. So rate increases, I think, are going to moderate. As far as kind of our strategy on rental growth and rate increases, it really varies from deal to deal. We'll analyze the duration of tenancy of our customer base. If someone's been there for 2 years on a deal we recently bought and they've never seen a rate increase, that guy's probably going to get a rate increase pretty soon. And we also analyze our rate increases not only from a percentage perspective, but from a gross dollar increase perspective. So if someone's paying $30 a month, you could probably increase their rate, well over 10%, and it's not going to move the needle for them much. They're probably not going to move out. But if a guy paying $300 a month, you increase his rate by 10%, that $30 might be enough for him to get a buddy in a moving truck and, put his stuff back in his house. So we kind of balance those rate increases against the gross dollar increase and also the percentage.
Got it. And we haven't talked about vacancies yet. What is the typical vacancy rate you guys experience?
It depends on the deal we buy. We'll buy some deals that are completely empty, and some deals that are at 95%. We consider a stabilized property to be high 80s, maybe 90. And it's interesting in storage because if you're completely full, that means your rates are too low and you need to course correct. So you want churn, you want new customers moving in and moving out. So ideally we're high 80s, low 90s, somewhere in there. That's what we target.
In any sense of what the changing interest rates and kind of the changing economy might do, or is that historically, what are your expectations with vacancies as the economy changes?
Well, I'm a student of history. I majored in history in college, and we kind of were commenting before we recorded, but it seems like as you try to look back and infer what's going to happen in the future based on the past, it seems like these events that have happened lately are so different from what's happened before. The world's changed so much, the access to information, globalization. So it's really tough to look back and say this happened before, now it's going to happen again, given these conditions. But if the economy continues to soften, historically, when there's a disruption event, demand for storage increases. People are moving more often. They're maybe downsizing homes, or they're moving from a single family home to an apartment. They're getting new jobs. They're moving from high tax states to lower tax states. They need storage for a year. So generally, disruption increases consumer demand. As it relates to interest rates, we commented on this a moment ago, but of course, values have to go down eventually if rates keep going up. They just can't sustain. So interest rate increases mainly are affecting our distributable cash flow. If we were financing at a 4 before, and now we're financing at a 6, our net income is going to be lower. So our cash on cash returns on a current basis are going to be lower too. But we all have short memories. We look at rates today, we think, oh man, they're so high. Well, relative to the history of debt in the US, interest rates are still pretty cheap. We financed a property in June of 19 at like 5.2% when we bought it. I'm like, oh, that's a pretty good rate. And we're getting the same rates we are today lately, or we were then as we are today on new acquisitions. So we're in the low to mid 5s. But those go up to 7 or 8. That's going to be a material change in how we're approaching our acquisitions and our capital stack.
No, it's so true. I can remember the first home loan I got 7 3/8, and I was doing cartwheels. I couldn't believe it was a great rate,
Yep.
and now you
Yep.
think like,
Yeah.
holy crap, how do you afford anything? That's
Yeah.
too
My
much.
parents got you beat. I think they were at like 16 or 17% or something, but
Oh yeah, no,
worked
there was
out, right?
definitely a time. You don't have to go back that far. I mean, I was aware, but not like it wasn't coming out of my pocket. But I mean, cyclical, and it just. I think that the one good sign is if the Fed can build up the Fed rate and keep the economy going, it does give you a relief valve if you need to get the economy going. You can drop the rate, but when you're sitting at zero for as long as we were, I mean, it's kind of hard to. Yeah, I mean, where do you go? You go to like negative rates, and
Yep.
so I think that
It's untenable, right?
yeah, so I think that it's healthy what's happening. It's the pain of change, I think, is really what we're all kind of trying to figure out. So, but that's I mean, really though, that's the opportunity. That's what the other side of that is I've come to realize is that the opportunity is in the change. If you're looking at yesterday trying to go, God dang, it's not what it was. It's the opportunity is in that change because there's going to be some people that want to get out regardless. The people that usually do well are the ones that get in, recognizing the opportunity
Yep.
and the price correction kind of thing. So, but if you don't
Yep.
have any capital, then you're 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 not going to be one of those. So, but no, it's all good. Um, hey Jacob, if we could, I'd like to shift gears here for a second. Um, as I mentioned before, by day I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when avoid nor minimize are options, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is.
Yep.
And as such, I like to ask my guests if they can look at their own situation. Could be clients, investors, interest rates, the market, political, whatever you would like to, or however you'd like to identify and recognize what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer.
Sure.
And so if you're willing,
Yeah,
I'd like to
absolutely.
ask you,
I've
Jacob
got a few
Vanderslice,
got a few thoughts here on
what's the
risk.
biggest risk?
Yeah, risk is a subjective thing to a degree based on who you're talking to. Um, I look at risk as the mitigation of a loss of principal. So, what is the story on this deal that would have to occur, or we would see a loss of capital? And we look at that more carefully than we do the upside scenario. Upside's a lot more difficult to quantify, but finding a story that creates downside is what we try to just eliminate. And I think in real estate finance, when someone crashes and burns, um, it is almost always because of a cash flow issue. It's always a cash flow issue. There's certain circumstances where you can fail not because of cash flow, but something maybe bigger, like COVID, for example. But we watch our cash flow very carefully, specifically in self-storage. When we buy a given deal, there are two risks to that acquisition, I think. Outside of things we can't control, interest rates and cap rates, where a rate's going to be in 5 years, where a cap rate's going to be in 5 years, we don't know, right? We can make a forecast, we can be conservative. But what we can control is our net operating income and our revenue. We have control over that to a degree. But the two risks on a given storage acquisition, we believe, are rents. Where are rents today, and where are rents going to be? And is that revenue stream achievable and reasonable that we've written into our model? And secondly, it's kind of getting in the weeds, but property taxes, I think, are a major risk. And property taxes in self-storage are variable, just like any asset class, from market to market. They're a lot higher in the Midwest than they might be in Denver. But because storage leases, much like multifamily, are basically full service, meaning the tenant doesn't pay the property taxes, those come straight out of the bottom line. So if you're accruing for property taxes incorrectly and you get reassessed, that's going to be a material change in your net operating income as well as the total value of your property. So that's something, rents and taxes are something we really analyze very carefully. And to mitigate the risk on the property tax side, we accrue for a tax bill that's a worst case scenario. So it is inconceivable the property taxes in the foreseeable future will ever go above this figure. And that's what we accrue for. And typically we come in well below that figure. Sometimes we get lucky. Sometimes it just doesn't get reassessed. We'll do some creative transfer things where we buy the entity versus buy the deal. But I know that seems kind of in the weeds, but if you think your property taxes are going to be $100,000 and they're 140, that's a massive delta. If you put a 6 cap or a 5 cap on that 40K in NOI, you've missed the mark on your deal's value by lots of money.
Yeah, no, I appreciate you emphasizing that, because I think that's something a lot of people, it's real easy to look at historical numbers and assess the thing from left to right and not recalibrate or really get a good sense of what the tax base and what's coming. A lot of times I have gotten those notices about hey, guess what? There was that measure passed, the bond measure passed or whatever, and all of a sudden the rate goes from here to there, and it's like, whoa. And so, and I'm guessing, do you, obviously, if you guys are looking at this and this is a big concern, are there jurisdictions that you have recognized that are just too tax averse? Is the risk too great to where you won't play, or is it more
where the risk is too great that we won't buy? Yeah. The seller is telling us, no, the taxes are going to stay here. Like, no, they're going to go up by a lot. They don't believe us, so we can't do the deal. One state that's pretty rough is Ohio. There, you got to be really careful about your property taxes up there. Illinois is another one. You've got to be just ultra conservative. And we kind of quantify the risk of that tax increase with a couple different ways. We hire third-party tax consultants, depending on the deal. We'll do our own in-house analysis by calling up the taxing authority, pre-flatting a scenario with them, calculating the mill levy, other property taxes in the submarket. So there's a lot of ways that we kind of analyze that and mitigate that risk. But some markets are scary and some deals are scary, and those are deals we just don't do.
No, amen. All right. Well, hey, Jacob, this has been great. Appreciate you taking the biggest risk question there and running with it. That's great. Where can listeners go if they'd like to learn more or connect with you?
They can email me, jacob@vanwestpartners.com. They can go to our website, vanwestpartners.com, or hit me on LinkedIn at Jacob Vanderslice.
Awesome. Well, Jacob, I can't say thanks enough for taking the time to talk today. I've thoroughly enjoyed it, learned a lot, and I look forward to doing it again soon.
Darren, I enjoyed it. Thanks for having us on.
You got it. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.